What if I told you there's a financial web of bets and promises so vast, it makes the one that blew up in 2008 look tiny? We're talking about the global derivatives market, a system with a staggering headline value of $699 trillion. And the most alarming part? A huge chunk of the risk inside the US banking system is held by just four of America's biggest banks. The scariest thing is that some of the patterns that led to past financial meltdowns are starting to rhyme with what we see today, and almost no one is talking about it. In the next few minutes, I'm going to break down what this derivatives market is, how it got so enormous, and why history gives us a chilling warning that it's not a matter of if a crisis will strike again, but when. Let's start with that number, $699 trillion. It's a figure so big it's almost meaningless. For a little perspective, the entire world's economic output, our global GDP, is around $100 trillion. So this derivatives market is about 7 times the size of the entire planet's economy. But what is it really? When you hear that number, it's easy to picture a giant mountain of debt, but that's not quite right. It refers to the notional value of all the derivatives contracts out there. Think of notional as the face value of a bet. If you bet $10 on a horse race, the notional value is $10. It's the amount the contract is based on. While not every dollar is at risk of being lost, the sheer size of this number shows just how interconnected and leveraged our financial system has become. So where are all these bets on? The vast majority, about $548 trillion worth, are interest rate derivatives. These are essentially wagers on where interest rates will go in the future. Here's a simple analogy. Imagine you run a company that needs to borrow a lot of money next year. You're worried the central bank will raise interest rates, which would make your loan way more expensive. So you go to a bank and sign a derivative contract called an interest rate swap. You agree to pay the bank a fixed interest rate, and in return, the bank agrees to pay you whatever the floating market rate turns out to be. You've just locked in your cost. You've hedged your risk. It sounds pretty sensible, right? In isolation, it is. But our financial system didn't just create a few of these. It created a mountain. The daily trading volume for these over-the-counter interest rate derivatives has surged to an incredible $7.9 trillion per day as of April 2025. That's a 59% jump since 2022. The system isn't just big, it's churning at a frantic, accelerating speed. This hyperactive trading isn't all just simple hedging. A huge chunk of it is pure speculation, straight-up betting. And when you have a system of bets 7 times the size of the global economy, with trillions changing hands every day, you've got the ingredients for an explosion. The question is, who's holding the fuse?